With the S&P 500 hitting new highs, it has become more and more challenging to find value in the markets. However, I am someone who believes that there is always value somewhere. There is always a sector, an industry, or an individual stock that is undervalued, and my channel is dedicated to finding these pockets in the market. So every month, I make a video on the stocks I think are looking cheap in the market, and it's time that I made this video for July. So in today's video, I want to share 5 stocks that I think are still looking cheap. However, before we get into today's video, I want to let you all know that this video is sponsored by Moomoo. Moomoo is an online brokerage that is trusted by over 20 million users around the globe and has many stock analysis features, especially for dividend investors. For example, Moomoo has a high dividend yield feature. This helps you find high dividend yielding stocks quickly within the market that you are interested in. For example, if you are a Canadian, then you can easily find all of the highest yielding Canadian dividend stocks. Additionally, Moomoo has a dividend calendar, which shows you which stocks are paying their dividends on what days. This helps you stay informed on when businesses are paying their dividends, so you can know when to expect your own dividend payments. Moomoo makes it easy to start investing with no minimum account fees and a self-selection of RRSP and TFSA accounts. Moomoo also has low commissions, such as only being charged $1.99 per US dollar trade. Compared to other brokers who charge up to $9.99 per trade, Moomoo can save you up to $8 per transaction. Moomoo currently has a welcome promotion of $2,000 in free commissions as well, and 6% APY on cash for the first 60 days. If you're interested in checking out Moomoo and taking advantage of these offerings, then make sure to click the link in my description to go and check them out. And again, thank you to Moomoo for sponsoring today's video. Now with that being said, let's hop into the 5 stocks that I think are looking cheap in the month of July. Alright, so the first stock that I want to talk about in this video is QLYS or Qualys. And this is actually a stock that I have had on my watch list for a very long time. Since its IPO in 2012, this stock is up 962%, and it has massively outperformed the S&P 500 since becoming a public company. The stock is currently in about a 32% correction from its all-time highs though. Qualys was also founded in 1999 as one of the first SaaS security companies. Qualys has established strategic partnerships with leading cloud providers like Amazon Web Services, Microsoft Azure, and even Google Cloud. Qualys is a cloud-based service that gives you immediate global visibility into where your IT systems may be vulnerable to the latest internet threats and how to protect against them. It helps you continuously identify threats and monitor unexpected changes in your network before they turn into breaches. So basically, Qualys is a cybersecurity company that was founded back in 1999, and it was actually one of the first cybersecurity companies. All of the markets that Qualys operates in are currently worth about $50 billion in 2024. However, by 2027, they are projected to grow by 43% to $72 billion. The growth of the cybersecurity industry is providing tailwinds for Qualys' business, and this has been what has been driving the stock and the company's fundamentals higher. Qualys also has over 10,000 different companies that have a subscription with the business. Some of these are the largest companies in the world as well. 70% of the Forbes 50 companies use Qualys. 54% of the Forbes Global 500 companies do as well, and 32% of the Forbes Global 2000 also do. So Qualys, again, has some of these largest companies in the world as their customers. Now, what I want to quickly do is head back over to Stock Unlock Insights because Qualys has an insight score of 4.21, which is very good. And there's actually not a lot of stocks that I even see on the platform that have a score this high. And if we scroll down, we can see that Qualys has a perfect 5.0 profitability score with an 81% gross margin, 30% operating margin, 28% net margin, and a 45% free cash flow margin. So almost half of the company's revenue becomes free cash flow for the business. And again, it is a very profitable business. However, its management score is lower at 3.4. And the reason for this really is because the company does do a lot of stock-based compensation. Stock-based compensation is 12% of revenue, 27% of operating cash flow, and 28% of free cash flow. So about a quarter of the free cash flow is being offset by stock-based compensation. Now, if we continue to scroll down, the growth score is 4.75. Revenue has grown by 12% in the trailing 12 months. Gross profits is 15%, operating income 30%, net income 45%, and operating cash flow by 41%. So the company's revenue is growing quite strong, and so are its profits, which is a great thing to see. Now, another thing that I really like about this business is it does have a very strong balance sheet. We can see that its current ratio is above 1, which is good. It's also debt-free, so it doesn't have any long-term debt, It has low intangible assets. Its shares are increasing slightly, but it does have more cash than current liabilities. So if the company wanted to, it could use its existing cash position to pay off all of its debts that are due within the next year. So again, the company's balance sheet is very strong. And in addition, it is also a very profitable business that is bringing in a lot of cash flow. So this business should not be in any financial stress anytime soon. So now let's go and take a little bit of a deeper look at the company's long-term revenue growth. And here we can see that since 2012, every single quarter, the company's trailing 12 months revenue has grown. This is an absolutely beautiful chart right here. And this is just a thing of beauty. And the company is hitting all-time high revenue right now. If we also take a look at the company's operating cash flows, we can see that they are at an all-time high of about $263 million in the trailing 12 months now. But let's go and take a look at the actual cash flow figures right here. So again, we can see that operating cash flows has been $263 million in the trailing 12 months, but we can also see that the company did $72 million of stock-based compensation, which again is about a quarter of the overall operating cash flow. This is a lot of stock-based compensation, and it is a little bit on the higher end for myself personally, but you can make your own decision here. Now, the next number I want to point out is the capital expenditures right here, which is only $6.8 million in the trailing 12 months. And what I love about these software companies is the capital expenditures is a very low amount of the operating cash flow, which basically means that the company doesn't have to spend a lot on CapEx to actually produce these profits and grow profits as well. And what this ultimately leads to is a very profitable business, which we can see here of $256 million in free cash flow. So you can see that basically all of the operating cash flow did become free cash flow for the actual shareholders. And it does look like Qualys has been buying back shares in the trailing 12 months of about $70 million with organic free cash flows, which is a good thing to see. However, what was also interesting is we can see that Qualys is buying back about $70 million of shares in the past year, but we did see on our Stock Unlock insights that the company's share count has grown over the past year as well. And this is because the stock-based compensation was $72 million in the trailing 12 months. So the share repurchasing of about $70 million did not fully offset the dilution from stock-based compensation. It almost entirely offset it, but it didn't quite because they are doing slightly more stock-based compensation than share buybacks, which I think is just interesting to point out. Next, I want to take a look at Qualys price to free cash flow today, which currently is right around 20. Now, if we take a look at the company's 9-year historical average, it has been about 27.8. So it is trading about 30 to 40% below its historical average price to free cash flow ratio right now. And we can also see that it is trading near its record low price to free cash flow ratio. To put this in perspective, during the stock market crash of 2020, Qualys price to free cash flow got down to about 22.75. So it's actually cheaper right now on a price to free cash flow basis than it was during the stock market crash of 2020. So it seems like the market is actually quite bearish towards this company right now. So then my question was, why is it trading so cheap? So I went and took a look at the company's guidance for 2024. And we can see here that management is expecting the revenue for 2024 to be in the range of $601.5 million to $608.5 million, representing growth of 8 to 10% over 2023. So basically, the company is expecting 8 to 10% revenue growth for the year of 2024. Now, if we head back over to Stock Unlock, we can see that in 2020, Qualys grew its revenue by about 13%. And this was the slowest revenue growth year for the company. So now that the company is projecting about 8 to 10% revenue growth in 2024, it means that this year is actually the slowest revenue growth year in the company's entire history, which is not a very good thing to see. And I do think that this is why the stock is selling for those low price ratios today. However, if we head over to Stock Unlock's discounted cash flow calculator and we project out the free cash flow over the next 5 years, and we say that the free cash flow will grow at 10% annually, which is well below the company's historical average growth rates, and they'll buy back about 1.9% of their shares annually, which is their 5-year average buyback rate, and trade for a 20 price to free cash flow, which is what the company is trading for today, and is significantly below its historical averages, then we still get a compounded annual growth rate to the stock of about 12%, which is a market-beating return. And in my opinion, these are pretty pessimistic numbers right here, because again, the price ratio is well below the company's historical averages, and the growth rate is also well below the company's historical averages. And if the company can meet these metrics right here, then again, it can produce market-beating returns, and that is why I think that the stock is looking interesting at the moment, while it is in around a 40% correction from its all-time highs, trading for historically low price ratios, and potentially offering market-beating returns going forward. Qualys ultimately looks like a very profitable business with extremely high profit margins, growing its revenues at around 10% annually, also with a very strong balance sheet. And for those reasons, it is the first stock that I wanted to talk about in this video. All right, now let's move on to the second stock that I want to talk about in this video, which is Evolution AB with the ticker symbol EVVTY. Now, this is a gambling company, but it is an interesting gambling company in my opinion. So yes, it is a sin stock, but trust me, you want to see the metrics on this business because it has been performing incredibly well. Evolution IPO'd in 2016, and it is up 1,637% since its IPO. So it has massively outperformed the S&P 500. However, the stock is now down 47% from its all-time highs, which is a pretty significant correction and is one of the reasons why I am interested in the stock right now. Evolution is a leading B2B solutions provider for casino operators, offering live casino, live game shows, slots, and more. Evolution's customer base includes global online operators, platform providers, and an expanding number of land-based casinos. Evolution's one-stop shop is a single platform that enables casino operators to achieve simple, fast, and unified integration of Evolution's casino games. A single integration gives access to the full suite of Evolution's games and products. Evolution provides this integration, then the operators change the branding to their own branding and provide it to their customers. This allows other companies to set up online casinos and games extremely quickly. It's basically a casino API or a casino as a service business, which I do think is very interesting. Evolution can even help its customers with their own promotions, reward programs, and even more. So it's a very useful and value-added business for any other company that wants to set up their own online casino. Now, what's interesting is the global online gambling industry grew by about 12.9% in 2024. And it is projected to grow at 6.2% annually out to 2029. So the overall growth of this industry has been providing tailwinds to Evolution's business, and it seems like it will continue to do so. In the first quarter of 2024, Evolution grew its revenue by 16% year over year, which means that it did outperform the overall growth of the industry, and also could suggest that the business is taking market share around the world. The growth to its revenue was mostly led by Asia, so it seems like its business over in Asia is expanding very well right now. Now, if we head back over to Stock Unlock and take a look at its long-term revenue growth, we can see that its revenue has been absolutely exploding and is currently sitting at an all-time high. Now, if we take a look at the percent change numbers right here, we can see that the revenue growth has been slowly decelerating over the past about decade now. And it is sitting at about 4% quarter over quarter growth in the trailing 12 months. However, it does also seem like the revenue growth rate has been settling around this 4% quarter over quarter growth. The data does suggest that people spend less money on gambling during recessions. So if we see any more economic weakness, then Evolution may continue to see a slowdown to its overall revenue. However, this business is still growing its revenue at 16% annually, which is a strong growth rate that far outpaces the overall industry that it operates in. If we also take a look at Evolution's operating cash flow, we can see that it has been exploding over the past decade and is currently sitting at an all-time high of about 1.2 billion euros in the trailing 12 months now. So now let's take a look at its actual cash flow statement. So we can see that it had about $1.2 billion of euros come in, and it spent about 108.5 million on capital expenditures. So this is another very profitable business, and it also means that it generated about 1.08 billion euros in free cash flow in the trailing 12 months. Now, if we take a look at how the company spent all of this free cash flow, we can see that it bought back about 370 million euros of stock in the past year and paid a dividend of about 427 million euros. So it seems like about 80% of the free cash flow went to paying a dividend and buying back shares. So this company is growing its overall revenues and its profits, and it is returning those profits back to shareholders through paying a dividend and buying back shares, which I love to see. Now, if we take a look at Evolution's price to free cash flow today, we can see that it is sitting at about 19, and its historical average since 2017 has been about 38.6. So this company is trading well below its historical average price to free cash flow ratios, and a 19 price to free cash flow for a business that is this profitable and growing its revenues at 16% annually, I do think looks like a very attractive stock. Again, that's a 19 price to free cash flow for 16% annual revenue growth on a highly profitable business that seems to be taking market share and growing around the world. A 19 price to free cash flow also seems to be around the lowest that this stock has ever traded for. So quite literally, this is the cheapest the stock has been in terms of its price to free cash flow ratios. Now, I also want to head over to our Stock Unlock discounted cash flow calculator here And we are going to project out the free cash flow over the next 5 years. And we are going to say that the free cash flow is going to grow at about 10% annually over the next 5 years. The company is going to buy back about 1% of its shares on an annual basis, which we can see the company is buying back shares right now. And its dividend will grow at 10% annually in line with the overall free cash flow growth, and maintain a 20 price to free cash flow, which again is well below the company's historical averages. And when we put in these metrics right here, we get a compounded annual growth rate to shareholder value of about 14%, which is significantly above the S&P 500's historical average of 10%. And just like with Qualys, I do think that these are pessimistic numbers as well. A 10% free cash flow growth rate is significantly below the company's historical averages, and a 20 price to free cash flow I do think is cheap for this business, and is also well below the company's historical averages. And even with these pessimistic numbers, it looks like the stock could deliver market-beating returns going forward. So this is another rapidly growing business that is incredibly profitable, seems like it is taking market share around the world, and seems like it does have a long runway for future growth, that is also trading for all-time low price ratios, and could deliver market-beating returns over the next 5 years if it can continue to grow at least 10% annually. So for all of those reasons, I put this stock at number 2 in this video, and I do think that this one is looking very interesting in the market today. All right, now let's move on to the third stock that I want to talk about in this video, which is BN, or Brookfield Corporation. Now, you guys, if you watch my channel, you know me, and you know that this would not be a Daniel Pronk video if I didn't at least talk about Brookfield a little bit. Now, Brookfield has actually been performing quite well recently. If we take a look at the stock, it is up roughly 46% from the lows that it was selling for here in about October of 2023. Despite Brookfield being up roughly 46% from its lows though, I do still think that this stock is looking cheap. However, this is a stock that I talk about a lot on my channel, so what I want to do in this video is tell you guys about the new updates that came out with Brookfield and also further elaborate on some of the assets that this business owns. Alright, so the first update is from just a few days ago now, and this one says that Brookfield is looking to acquire a Spanish blood plasma pharmaceuticals company. This company's stock is down 70%, and Brookfield is now looking to take advantage of this and buy the entire business. Brookfield is a value investor, so this makes sense, as long as Brookfield believes that it is getting a good deal and can manage the company well once it does acquire it. Rachel Reeves also put £7.4 billion into UK's National Wealth Fund, and it is getting Mark Carney to help manage these funds. Mark Carney is on the chair of Brookfield Asset Management. He is focused on the development of products for investors that will combine positive social and environmental outcomes with strong risk-adjusted returns. So the UK Wealth Fund chose one of Brookfield's chairmen to help manage its capital. I think this is a huge vote of confidence for Brookfield overall. So now let's get into some of the assets that Brookfield owns. And here we can see that in 2019, Brookfield acquired Genesee and Wyoming, which is known as G&W, a leading short-haul operator with a network of over 220,000 kilometers of railroad track across the UK and North America. And if you guys have been watching my channel, then you also know that I do love railroad companies, so I love to see that Brookfield has 22,000 kilometers of railroad tracks and operates a railroad network in the UK and North America. Brookfield is also a leader in data center infrastructure in Latin America. And today, Ascenity, which Brookfield owns, is the largest whole data center provider serving Latin America, with the majority of its operations located in Brazil. So Brookfield is the largest data center infrastructure provider in Latin America and down in Brazil. Brookfield also owns a natural gas pipeline that accounts for more than half of Brazil's natural gas demand. So Brookfield is the leading supplier of natural gas to Brazil, and it has over 50% of the market share. Brookfield also serves Pennsylvania with hydropower, and in fact, it has enough hydropower to power more than 100,000 homes annually. So Brookfield is supplying over 100,000 homes in Pennsylvania with clean hydropower. Brookfield also supplies over 90% of Maine's hydropower, and Maine gets around 25% of its total power from hydropower, so Brookfield is supplying roughly 21% of the state's entire power through clean energy, and again, this hydropower. Brookfield also owns Westinghouse, which is the largest provider for infrastructure services to the world's nuclear power facilities, providing fuel, maintenance, and repair services, plant components and parts, and sophisticated engineering services to 2/3 of the world's nuclear generation plants. Westinghouse is an amazing business that was acquired by Brookfield, and if the nuclear industry grows over the long term, which I think it will, then Westinghouse should benefit massively, and so should Brookfield. Brookfield also owns Clarius, which is the global leader in automotive battery manufacturing and distribution, producing 1/3 of the automotive industry's total output per year. So if the electric vehicle market continues to grow, then again, Brookfield should benefit massively from it. Brookfield also provides critical water and sanitation services to Brazil. The business provides critical water and sanitation services through exclusive multi-decade contracts and serves more than 16 million people in over 100 cities down in Brazil. Water sanitation is absolutely essential, and Brookfield again has multi-decade contracts in place to continue supplying Brazil with clean water. So you can see that Brookfield is in a little bit of everything, and when they say that they own the infrastructure that supports the global economy, they truly mean it. So now let's get into some actual metrics from Brookfield and why I like the ticker BN so much. So this screenshot right here from Brookfield's most recent investor presentation says that BN captures all the value that Brookfield creates. We delivered strong operating results, generating roughly $5 billion in distributable earnings in the past year. We are also set up to grow earnings at 20% per year over the next 5 years. We expect to generate $45 billion of free cash flow over the next 5 years that will drive additional growth through cash reinvestment. This is all underpinned by our strong balance sheet and high levels of liquidity. We are well positioned to deliver 15% plus total returns per share over the long term, and we have never been in a better position to sustain growth and deliver attractive returns over the long term. So there's a lot to like about Brookfield right now. Again, the company did about $5 billion in trailing 12 months earnings. They're projecting to grow that at 20% per year. They're projecting to produce about $45 billion in free cash flow over the next 5 years, and they are expecting 15% plus total per share returns over the long term. We can also see that the company is expecting to produce about $3.20 in free cash flow per share in 2024, and this is projected to grow to $7 per share in free cash flow by 2028, which again is a 20% compounded annual growth rate. Now, when we factor in that $45 billion of free cash flow and the company reinvesting those profits back into the business, then this could generate an additional $1 in per share of free cash flow by 2028, which is a roughly 25% compounded annual growth rate. Now, if we head back over to Stock Unlock very quickly, we can see that Brookfield is a $70.6 billion business in the stock market today. And again, they generated $5 billion of trailing 12 months free cash flow, which means that the business is trading for roughly 14 times free cash flows today. The business is also projecting to grow its free cash flow by 20 to 25% annually over the next 5 years. So basically, when I take a look at Brookfield, I see a business that is trading for roughly 14 times free cash flow and projecting 20 to 25% annual growth, which I think is a massive disconnect from the company's underlying intrinsic value, and that is why Brookfield is the largest position in my own portfolio. Brookfield also has an incredible management team that is led by Bruce Flatt, and the management owns roughly 20% of the total shares of this business, so they are heavily invested in the business, and they have a long track record of meeting and exceeding their own targets. So for all of these reasons, again, Brookfield is the largest position in my portfolio, and I do still think that it is looking cheap in the stock market. And full disclosure, I am actively buying more Brookfield shares, and I have been buying more Brookfield shares over the past month. All right, but now let's move on to the fourth stock that I want to talk about in this video, which is none other than Amazon. Now, Amazon has been in my monthly stocks to buy videos for about 3 months in a row now, I think, and the stock is finally hitting fresh all-time highs of roughly $200 per share. However, I do still think that Amazon is looking arguably undervalued in the market, and that is why I am putting it in this video once again for probably the 3rd time in a row. There also hasn't been too much recent news coming out with Amazon, and the only real major news that came out was in regards to Amazon offering cheaper products from China. So right here, this says that Amazon plans to launch a section of its shopping site featuring cheap items that can ship directly to overseas consumers from warehouses in China, according to slides shown to Chinese sellers, marking the e-commerce giant's most aggressive response yet to the growth of bargain sites like Temu and Shein. So I'm not sure if you are all familiar with Temu, but PDD, which is a public stock, does own Temu. And Temu has been growing massively around the world. The PDD's revenue has been growing ridiculously well, and this is a cheap Chinese company that does sell products from China directly to international customers via an online website like Amazon. So it seems like Amazon is now planning to launch its own Temu type business where international customers can buy products directly from Chinese warehouses, probably for quite cheap. And this is going to completely bypass businesses like Temu. Now, my thoughts on this are that this is probably going to be bullish for Amazon over the longer term. And is Amazon really trying to compete with these low-cost Chinese online retailers? However, we don't really know the margins on this business yet, because if Amazon is going to be selling very cheap products around the globe from China, then I have to imagine that the profit margins on this business is probably going to be quite low initially while it is being set up. And over the longer term, I do expect the margins on this business to be quite low as well. So in terms of how much this is actually going to grow Amazon's cash flows, I don't really know right now. And I am not the most optimistic or bullish on this event, at least in the short to midterm. So with that being said, let's quickly dive into why I think that Amazon is still looking cheap in the market today. And this really stems from the company's growth to its overall operating cash flow, which is my favorite metric to use when I am valuing Amazon. So here we can see that Amazon's operating cash flows are just exploding right now. And the company has produced about $99 billion in trailing 12 months operating cash flow now. And when I take a look at this operating cash flow chart right here, it suggests to me that Amazon's operating cash flows are probably going to continue growing over the long term, because again, they are just exploding right now. So I don't really think that it is hitting a ceiling right now, and I do think that this trend is going to continue. Now, when we take a look at Amazon's price to operating cash flow, which is my favorite valuation metric to use when I'm looking at Amazon, we can see that it is currently trading for a price to operating cash flow of about 20.9, which is above the lows that it was here at about 18.2 back in, what would that be, about April of 2024. So the price ratios have expanded slightly, but when we take a look at Amazon's long-term average price to operating cash flow, it's about 27.7, which ultimately means that Amazon is trading roughly 30% below its long-term average price to operating cash flow, at the same time as the business's operating cash flows are exploding and probably growing at some of the fastest rates the company has ever seen. So basically, Amazon is still trading well below its historical average price ratios, and the business looks like it is only going to continue growing its operating cash flows going forward. Now, I also ran a very quick DCF calculation on Amazon, and in this calculation, we are going to be using the operating cash flow over the next 5 years, and I am saying that Amazon is going to be able to grow its operating cash flows at about 10% annually over the next 5 years. I am also accounting for about 1% dilution to account for Amazon stock-based compensation, and I'm going to say that Amazon is going to trade for a 25 price to operating cash flow, which is still below the company's long-term historical averages of about 27 to 28. Now, when we input these metrics, we get a compounded annual growth rate to the share price of about 12.8% annually, which is a market-beating return. Now, I also do think that this 10% annual growth rate to operating cash flows is on the more pessimistic side, because over the past 5 years, Amazon has grown its operating cash flows at about 23% annually. So personally, I do think that Amazon can actually beat this 10% annual growth rate to its operating cash flows, but I do like to be a little bit more pessimistic and on the conservative end when I do discounted cash flow calculations. And when I am conservative, at least in my own opinion, Amazon could still produce market-beating returns going forward, and for those reasons, I do think that Amazon is looking arguably cheap in the market today. All right, now let's move on to the fifth and final stock that I want to talk about in this video, and this one is Alibaba. Now, Alibaba has also been in my cheap stocks videos for quite some time, and I am not sure when this sentiment towards China will change, but in the meantime, this stock is looking very cheap. Right here, we can see that Alibaba has a price to free cash flow of only 8.24, which is a free cash flow yield of 12.13%. Now, what this means is that if Alibaba wanted to pay out 100% of its free cash flow today, then it could pay out a 12% dividend to its shareholders if the company wanted to. Now, since I have talked about Alibaba so much on my channel, I want to do what I did with Brookfield and give you guys some business updates and share some recent news that is coming out with the stock and kind of elaborate on why I think that it is cheap today. The first piece of news is that recently Alibaba raised $4.5 billion through convertible senior notes, and they said that this was to fund concurrent share repurchase activity. And this debt has a coupon rate or an interest rate of only 0.5%. So basically, Alibaba raised $4.5 billion through debt with a 0.5% interest rate to then go and buy back shares of this stock at a 12% free cash flow yield. In my opinion, this was a very good move because a 0.5% interest rate is basically free money, especially in this current market environment. And then Alibaba can go and take this money and buy back shares while they are extremely cheap and offering a 12% free cash flow yield. This is basically getting money at 0.5% and then getting a 12% return on that money. So again, in my opinion, I actually think that this was a very good move by Alibaba. Alibaba also recently put out a little bit of an update in terms of their share repurchase program. And this says, Alibaba Group repurchased $5.8 billion worth of ordinary shares during the most recent quarter. a net reduction of 2.3% in its share repurchase program. So in the March to June quarter, or the second quarter of 2024, Alibaba did repurchase $5.8 billion worth of shares and reduced its share count by 2.3% in just one quarter. Now, on an annualized basis, this is about 9.2% of the overall share count. So if Alibaba continues repurchasing shares at this rate, then it will remove around 9% of its shares over the next year, which is a massive return to shareholders. The company also pays a dividend of 1.3% today, which means that it's returning over 10% to its shareholders through buybacks and dividends now. So Alibaba is returning a lot of capital back to shareholders and rewarding shareholders through share repurchasing and dividends now. This graph right here shows us the actual amount of share repurchasing that Alibaba has done historically. And here we can see the most recent quarter again was at 5.8 billion, and this was a record high for the business. And the share repurchasings are actually continuing to grow. Now, moving on to the next key piece of news, the CEO recently put out a letter to shareholders and really a letter to the public. And there are some key things in this letter that I want to point out to everyone. So the first thing here says, we take a long-term perspective when making hard decisions. We think in 10-year cycles. I always love to see a CEO say that they think about the long term, and they're really focusing on the long term as well. Then the next point here is second, we apply extreme focus and intentionality in everything we do. We made a hard choice to forgo short-term revenue from low-margin project-based business. This is the CEO basically saying that they will sacrifice short-term revenue growth for long-term benefits to profitability. And I actually do love to see this as well, because it shows us that the management and the CEO is prioritizing the long-term profitability of the business rather than chasing short-term revenue growth. And in my most recent Alibaba earnings update, I did say this as well, because Alibaba is kind of getting rid of some of their low-margin, unprofitable revenue to actually focus on the profitability of the business again. And over the long term, I do actually expect the revenue growth to start re-accelerating once this low margin revenue is ran off from the business. And then the last thing here is the CEO says, we have developed employee incentive systems that are tied to our mid and long range strategic goals so that our teams know exactly where they stand financially based on the business performance. I always love when a business puts incentives in place that align employees with mid to long term financial goals. Then the last thing that I want to point out from the CEO letter, Alibaba is about the future. In the past 25 years, Alibaba has grown consistently, but unfortunately, acquired large company characteristics. For the next 10 years, we see ourselves again as a startup defined by entrepreneurship, innovation, and our mission to make it easy to do business anywhere. We will apply long-term thinking when we make trade-offs today and invest for tomorrow. So overall, I really like this letter from the CEO, and in my opinion, it sounds a lot like a Jeff Bezos letter and reminds me even a bit of Constellation Software. I really like this new CEO, and I think that he is doing the right things. So now let's move on to the overall Chinese cloud market share right here. And here we can see that Alibaba has the #1 market share in China in terms of its public cloud revenue, with about 39% of the overall revenue. We can see that back in 2019, Alibaba had 46% market share. Then it kind of declined all the way down here to about 35% in the first quarter of 2023. And then over the most recent quarters, Alibaba's market share has started to increase once again to about 39% today, which makes them the largest cloud operator in China. Now, why I see this as a good thing is because the public cloud revenue in China in 2024 is expected to be about $60 billion. And by 2029, it is projected to grow to $154 billion. So it is projected to grow by about 150% over just the next 5 years. Now remember, Alibaba's market share of the public cloud in China is 40%. So if this market is projected to grow by 150% over the next 5 years, and if these estimates are accurate and actually come true, then this could mean massive tailwinds and benefits for Alibaba's overall business. And their cloud division could see massive growth over just the next 5 years as the overall market expands dramatically. So now let's head back over to Stock Unlock, and here we can see that Alibaba's revenue kind of went through this period where it wasn't really growing that much in 2022 and 2023, but in the most recent quarters, Alibaba's revenue growth has started to re-accelerate a little bit, and personally, I do think that Alibaba's revenue growth will start to re-accelerate again over the mid to long term. If we also take a look at Alibaba's free cash flow margin, we can see that it did start to decline in a pretty big way in about 2017. And now in the most recent quarter, its free cash flow margin has been at about 16%. But now that Alibaba is focused on its profitability, running off low margin business, selling off business units and assets that are also unprofitable, and really refocusing back on the core of the business that is actually profitable, then I do think that Alibaba's free cash flow margin will start to improve going forward. So basically, I think that this is the bottom for Alibaba's free cash flow margin, and over the short to medium term, I do expect it to get back up in a pretty meaningful way. This ultimately means that Alibaba could continue to see revenue growth and margin expansion at the same time as it is aggressively buying back shares at a rate of about 9% per year now. What this ultimately leads to is a perfect recipe for free cash flow per share growth. And at an 8 price to free cash flow, I don't think that any of this growth is currently being priced in to Alibaba stock at all. And let's head over to Stock Unlock's free cash flow calculator to show you what I mean here. So we're going to project out Alibaba's free cash flow over the next 5 years, and I'm going to say that Alibaba's free cash flow is not going to grow at all over the next 5 years. However, the company is going to continue buying back 9% of their shares on an annual basis, which is what the company is currently doing. I'm also going to say that the dividend is not going to grow over the next 5 years, and Alibaba will trade for a 10 price to free cash flow, which is significantly below the company's 5-year average of 20. So in my opinion, these are actually very pessimistic numbers right here, okay? And even with these numbers, we get a compounded annual growth rate to the share price of 12.5% annually, which is a market-beating return. And this return is really being led by a 9% annual reduction to the share count and a slight multiple expansion to a price to free cash flow of about 10. So again, based on these metrics right here, Alibaba could deliver market-beating returns, and I do think that they are a little bit pessimistic. Because personally, I do think that Alibaba's free cash flow will actually grow over the next 5 years. So based on all of this reasoning, I do actually believe that Alibaba is still cheap in the market, and that is why I wanted to add it to this video. But with that being said, those are the 5 stocks that I think are still looking cheap in the market for the month of July, and I really hope that you enjoyed this video. If you did enjoy this video, then please remember to leave a like on it, as it does really help out my channel, and I really do appreciate it. And if you want to stay up to date with the stock market and stay up to date with my monthly stocks that I think are looking cheap videos, then consider subscribing to my channel, because that would also be pretty awesome. But with that being said, that is going to wrap up the video for today, everyone. So thank you so much for watching. I truly do appreciate it, and I really hope to see you all again in my next one.